mode.
Hi guys, this is JC Parets. Thanks for coming. We'll get started as we start getting more people. This is also going to be recorded, so for anybody who's on the webinar, will receive an email with this link. So I really appreciate you guys coming. What I'm going to try to do is just walk you through how I really break down the entire world, the advantages of looking at stocks outside of the United States, as opposed to just staying here domestically. There's so many more opportunities out there, particularly if you're looking for an uncorrelated position or perhaps something to hedge U.S. equities or whatnot. But there really are huge trends that take place around the world where money is constantly flowing out of certain areas of the world or even specific countries, and then really going into other areas of the world and other countries, whether they're developed countries or emerging markets. And I'll try to get into a lot of that. If you guys have any questions, save them for the end, and we'll do a little bit of a Q&A. So for you guys that don't know me, a lot of you guys know me from allstarcharts.com. I've been writing on there constantly for almost 4 years now, and you can go back and see what I was writing, when I was writing it. I find a lot of value in that, me personally, to see what I was thinking and when, and you guys can go back and see that also. You follow me on Twitter and StockTwits at allstarcharts. I founded Eagle Bay Capital in 2012, really with the sole purpose of managing one portfolio, through an LP structure. And most recently, due to popular demand, a lot of people were asking for it. We now have a paid product, so we're really excited about that. And the idea is to really deliver the same research and technical approach that we use every single day and deliver that to our members as well. So we're doing the best we can. And I'm also a contributor to Yahoo Finance. You guys can see my charts and stuff there also. Here's just a little disclaimer to make my attorneys happy. Obviously none of this is any sort of solicitation for any fund or really, any buy and sell recommendations of any stocks or commodities or ETFs. So before you do anything, make sure you consult your advisors and your tax, your tax accountants and everything like that for advice. So this is strictly for educational purposes. I want to make sure that I reiterate that. Just want to go over, before we get going, just some basic concepts of technical analysis for perhaps those of you who are new to technicals or aren't really sure what my approach is. Just some real basic principles. Support and resistance. This is what we call polarity. This is really where it all begins, guys. This is supply and demand 101. What was formerly support should become resistance. In this case, we have support. Let's just call this a stock. It continues to bounce off this level. Once that breaks, and we know that demand has dried up, supply has really taken over. So any shoot back to that area, is really dominated by the sellers, which is what we call resistance. And it works both ways. What was formerly resistance should become support. In other words, where there were sellers, the sellers dried up, and that's why it ripped. On any retest, we know that that level is dominated by buyers and no longer sellers. So it works in both directions. Obviously, the market doesn't, keep that easy for us. We like to, keep an open mind when it comes to the market. Mr. Market likes to make it tough on us. So a lot of times you'll have these breakouts and they'll fail and they'll break down. In fact, we actually saw that in the Dow Jones Industrial Average and S&P 500 over the last couple of weeks. And then this week, you see the result of that as we're making new lows. So, once it starts to break down, you typically get violent moves in the opposite direction. Obviously, we saw that in the S&P 500 on Wednesday this week. So I love to take advantage of these. So I just kind of want to give you guys an understanding. It goes both ways. You'll get that whipsaw. You'll get that failed breakdown. And from those really come some of the best opportunities that I've ever seen. Because from failed moves come fast moves in the opposite direction. A lot of people are afraid of these failed moves. I personally like to look for them and take advantage of that. And that's really how I look at supply and demand. Same thing with your traditional patterns. This is a head and shoulders pattern. A lot of people might recognize it. When it breaks the neckline, it should roll over. But again, it's not always that easy. A lot of times these head and shoulders patterns don't work out. Why? Because markets trend by nature. That's just the way supply and demand works. So a head and shoulders pattern is a reversal pattern by definition. So essentially, looking for head and shoulders patterns, which a lot of people do for some reason, defeats the entire purpose of what we're doing, which is looking for trends. Head and shoulders patterns a lot of times don't work because the trend is so strong. So we like to take advantage of those. A good example of one of these is the S&P 500 in 2010. I believe it was either July or August. I can't remember off the top of my head, but take a look at that. And then obviously we've seen what the S&P's done over the last couple of years. So that's supply and demand of price. I just want to go over momentum and the way I use it. I like to use a 14-period RSI, which is the relative strength index. I say 14 periods because the market is fractal. So the way we do things on a daily time frame, we also incorporate that on a weekly time frame. I don't like to look at too many intraday charts, but if I did, and I'm using a 10-minute chart, for example, it would be 14 10-minute periods. If I'm looking at a monthly chart, it's 14 months. So again, just want to reiterate that the market is fractal. The momentum tends to behave differently if we're in a bull trend or a bearish trend, and it trades within a specific range. So historically, 70 is overbought, 30 is oversold. However, when a market is bullish, and we're in a bull market, momentum tends to bottom out in the high 30s or even 40s and never gets into oversold conditions. However, during rallies, it continuously gets into overbought conditions. The one up here on the top is a good example of that. The opposite is in a bear market. During rallies in a bear market, the momentum fails to get into overbought conditions. However, during the sell-offs, they get into oversold conditions. Sorry about that, guys. So that's really how it behaves, and I just want you guys to understand that concept before we keep going. And then the other way we use momentum is with divergences. When prices are making lower lows, you also want to see momentum putting in lower lows as well. If it puts in a higher low, that's what we call bullish divergence. Same thing if you flip this chart upside down. If prices are making new highs, you want to see momentum confirming that, making new highs as well. When it doesn't, we call that a bearish divergence. When you have a combination of a failed breakout and a bearish divergence, that's a very nice combination. We actually, speaking of the S&P and Dow, we got that over the last couple of weeks. Failed breakouts in Dow and S&P and bearish momentum divergences. So again, these are just a couple of simple concepts. So you have a basic understanding of the way I look at supply and demand, so that we can get going and start looking at the markets. And again, just the value of multiple time frames. I like to look at both daily and weekly time frames. The weeklies is to gain more of a structural perspective, and then the daily is to really for execution and risk management. That's where we look at the dailies. And I think it's important before making decisions to look at the larger time frame to get more of a structural perspective. In this case, we're looking at shares of Apple in a beautiful uptrend of higher lows and higher highs. There's nothing wrong with this chart. This was back in early September. Higher lows, higher highs, beautiful uptrend. But if you look at a weekly chart, it's not as pretty. Why? Because we're bumping up against historic resistance. Mind you, these charts are over a month old, and sure enough, Apple hasn't done anything. So if we were looking at just the daily chart, we would have been super bullish. We're looking at a weekly chart. It tells us to be much more cautious. And that, looking at a weekly chart in Apple, just as an example, has actually paid off very nicely over the last month. So these are just a couple of concepts. When you guys ask me, JC, why do you look outside the U.S., the United States? Why, we have so many opportunities here in the U.S., why look elsewhere? And the way I look at it is, why wouldn't we, if we have those opportunities? So here is a correlation matrix of all of the S&P sectors: financials, discretionaries, technology. There's a lot of green on this board, except for maybe the utilities. Why is there so much green? Because these are all U.S. stocks, U.S. sectors, and they tend to move together. The more green, the more they move together. So if you look outside the United States, these are 20 countries compared to one another, and there's a lot less green, a lot more reds and oranges and beiges and grays. Why? Because if you're looking outside the United States, there's much less correlation. And we have a zero correlation strategy. We don't care what the S&P 500 does. For us, it's just one country. I get it. We're in the U.S. and it's an important country. I get all that. But the way we look at it and the way the math works, it's just one country. And I think that this really, explains that well. So the way we look at it, we're looking across the globe. I want to see all the countries. I want to see how they're doing. And then once we figure out where the strength is or where the weakness is, we want to be able to take advantage of that. So where's the strength? Is the strength in emerging markets? Where in emerging markets? Is it in Latin America? Is it in Russia? Is it South Africa, South Korea? Where is the strength? And then where's the weakness? Are we seeing weakness in Germany, in some of the developed countries, in Canada? Where is the weakness? And then we want to figure out once we come to that conclusion where the strength and the weakness is, how do we want to execute that game plan? Do we want to just buy Germany because we love Germany, or do we want to short China because we hate China? Or is there a particular pair that we want to do well? And for example, at the end of the summer, the last 6 weeks of the summer, something like that, I felt as though being in the U.S. stock market, I wasn't super bearish, but I wasn't bullish either. I was kind of just neutral. So I really wanted to have an equities neutral position, and the long Brazil, short Germany worked out very, very well for that 6-week period where we wanted to be neutral. I think the last 6 weeks of the summer, I think S&Ps were up 1%, or the Dow was up 1%, something like that. And this particular pair was up, I don't know, 16%, 17%, something like that. So it's a good way to have an equities neutral mentality and still have a directional exposure. So we figure out, how we want to take advantage of it. And then once we figure out, let's say we want to be long Brazil, short Germany, again, just as an example, do we want to own the country ETFs? Or do we want to be in individual components of that ETF? In Brazil, like Vale, for example, or in Germany, we could, be in Deutsche Bank or something, something of that nature. In Spain, they all have different components that have ADRs that trade in the United States. A lot of them in the New York Stock Exchange. And you could just buy them like you can any other stock, Microsoft, Apple, anything like that. So then once we figure out how to do it, we ask ourselves, is it best to do it through an ETF, or is it best to be an individual component, or sometimes both? So let's just get going. Unfortunately, we'd literally be here all night, and I would totally do that because I enjoy this stuff. But truthfully, we're not going to be able to get across the entire globe. But I'm going to break it down into certain sectors so you guys can get a good idea for the most part as to how we look at the world. Here are emerging markets. You know the big names. China is a big component. Taiwan, Brazil, Russia, Mexico. These are the emerging markets. And there's not really much to like here. This chart goes back to the peak in 2007. You had the crash in '08 that we all know about, obviously. And we've just been in a down to sideways range over the last 4 years or so. There's nothing to like about emerging markets from a structural perspective. I look at a lot of charts. This isn't a pretty one. I like to use a 200-week moving average. Again, not necessarily for support and resistance purposes, but more so to get a better understanding of the trend and the direction of the trend. In this case, we have a flat 200-week moving average, which is the definition of a lack of trend. There is no trend, and really you don't need the moving average to tell us that. It's pretty clear that we've just been in a long range of dead money or losing money. And don't forget, a lot of people have been in emerging markets. There's opportunity cost in being in EM also, because in this case, fine, you haven't lost any money since the end of 2009 because we've been flat, but you could have been in a lot of other places making money. So don't just think that because you're flat, there's no risk. There's opportunity cost that you're in taking as well. So here we are, emerging markets. Nothing to like here. Looks like we're going lower, right? So then here are emerging markets relative to the United States. So we know emerging markets look like crap. And here we know the S&P over the last several years has done great. Here are emerging markets relative to the S&P 500 breaking huge support that goes back to 2006. A beautiful downtrend. We broke earlier this year. We rallied back to retest that support, and now we're rolling over hard again. This is an ugly chart. So when you talk about emerging markets by themselves, we know we don't want to be there. But now look at this opportunity of continuing to stay long the United States and being short emerging markets. So if you're in this trade, you're essentially flipping this chart upside down. For every dollar that you're long SPY, you're short an equivalent amount of, you're short $1 of EEM. And this trade has done very, very well, broke out this year, and is continuing this trend. I absolutely love it as money flows out of emerging markets and into the United States and developed nations as a whole, really. So here we can break down into some individual emerging markets. We'll use China as the first example. Here's China relative to EM. So for you guys unsure of how ratios and pairs trades work, all this is a ratio of China and emerging markets. So the numerator is China, FXI. The denominator is EEM, emerging markets as a group. So in this case, we can see, if the trend is going down, emerging markets is outperforming China. If the trend is up, it's China outperforming emerging markets. So in this case, I'm seeing a nice little base developing since the end of 2010. I really like the potential in this, but as you can see shaded in gray, there's overhead supply, there's resistance here. So as nice as this base might be, we want to see a breakout. And if we do get a breakout above the highs late last year, we could see a nice sustainable trend. Because like I told you guys at the beginning, in the case of these countries and these pairs, the trends tend to last for a long time, a really long time. I think a good example of that is this one, the emerging markets relative to the U.S. I think that's a great example of how long trends can last. So if we do see a breakout here, that would be great, but we'll be patient and we'll wait for it. So there's really nothing to do in China relative to EM. And here's China by itself. You know, again, what's there to like? Looks like emerging markets as a group, but somehow worse, right? So here's emerging markets as a group, and then here's China by itself. I mean, there's nothing to like at all. So you either want to be short China or out of China completely. You know, in all likelihood, it looks like we're headed back to those lows that we've seen over the last several years, which is down in the low 30s. And I got to tell you, the more times the level is tested, the higher the likelihood that it breaks. We could see a lot more downside in China. But for me, with a flat 200-week, I mean, for me, it's mostly just stay away from it. Likely head lower, though. So here's Brazil relative to emerging markets. Look how nice this chart looks. So not only do we not like emerging markets because they've been underperforming, Brazil has somehow underperformed emerging markets as a group, which is you would think it might even be impossible, and it's found a way. Look at this beautiful downtrend in Brazil relative to EM, making new lows, below key support, below a downtrend line. So not only do we hate emerging markets, we hate Brazil even more. Brazil might be one of the worst places to be on earth, and I think that getting that perspective that we already don't like emerging markets, and now Brazil's even worse than that, really gives us an understanding of how bad Brazil is. Here's India relative to emerging markets. Big difference, right? Brazil relative to emerging markets making new lows. India relative to emerging markets making new highs. So this is something that we're pointing to this spring, I believe in March or February, if I'm not mistaken. You know, when you had, Russia and Ukraine started their issues. And a lot of these emerging markets were breaking down, China, Brazil specifically, and Russia, obviously, and India was breaking out. I thought that was very, very interesting. If you guys want to email me, I could send you some of the details on what we were looking at and why, but you guys can see it. I mean, you have a failed breakdown, which is why I wanted to explain to you guys, how I look at supply and demand, and you have a breakout, not only above that former support level, but above the downtrend line at the same time. So we shouldn't be surprised that this market is rocking while Brazil relative to EM is getting destroyed. So within EM, we might not like emerging markets, but India compared to it looks great. Looks like it's still heading higher. Here's Russia relative to emerging markets. Again, like Brazil, some of the worst out there. I mean, look how terrible Russia looks. There's nothing to like. If we get above this red downtrend line, if we get above that broken support over the last couple of years, then maybe we can talk. But at this point, you just want to stay short Russia on a relative basis, or just stay completely away. So as we continue, here's South Korea relative to emerging markets. It looks a lot better, right? Maybe not as good as India, but it's been in an uptrend for a while. Since the bottom in early 2009, the problem is that we're facing some overhead supply here. So do we want to be super aggressively long South Korea relative to emerging markets? Probably not, but it's nice to know that South Korea looks better than some of the other emerging markets. Here's a beautiful base. Here is Taiwan relative to EM. And look how massive this base is. So we haven't broken out yet, but I got to tell you, I'm going to be really surprised if we don't, because this is such a huge base. And as they say, the bigger the base, the higher in space, right? So if we do get this breakout, I'm telling you guys, we can have a monster multi-year trend, 3, 4, 5-year trend where Taiwan essentially is outperforming emerging markets. We could see a monster move upon a breakout. So this is certainly something that we want to keep a very, very close eye on. We can continue here. Here's South Africa relative to emerging markets. And again, you have a beautiful downtrend. And and we're breaking a short uptrend that we've had since last year. So do we really love South Africa relative to emerging markets? Not really. In fact, it looks like it's actually rolling over, so not somewhere where we want to be aggressively long. Getting back to Taiwan, here are the weekly candlesticks of Taiwan. So we looked at Taiwan on a relative basis where we said in this chart, what a beautiful base this is and the amount of potential in it. But now that we're looking at Taiwan by itself, sure, we broke this downtrend line from the peak in 2007. However, we're failing to break out above the late 2010, early 2011 highs. Looks like a failed breakout and more downside to me. I look at this chart and what I want to see is time. Maybe go down and test that downtrend line, maybe test the 200-week, and really just consolidate in order to have enough legs to really get going and have a sustained move. Momentum does look great. Notice how it's been in a bullish range really since it got out of it in 2009. Notice how during these sell-offs, we haven't gotten into oversold conditions, yet on rallies, we hit overbought conditions. So structurally, it looks good on a relative basis compared to EM. There's a ton of potential. But in the short term, there's really not much to like. You have that failed breakout, right? You see that? How we broke out to new highs and then quickly failed. You see how fast we've come down over the last couple of months? That's standard behavior after a failed breakout, and as you can see down below, a bearish divergence as well. So as much potential as there is in Taiwan from an execution standpoint, it's really hard, because now on a short-term momentum is in a bearish range. You have a failed breakout. Like the weeklies chart is telling us, what would make me feel most comfortable? Some time. So I think we see the potential, especially on a relative basis. But execution-wise, we want to be picky. We can look all over the world, and we do, but we don't have to be in everything. We can be very, very, very picky with our execution. So it's good to know and have a nice perspective. Getting back to India, here's India. We know that we love it on a relative basis. Here it is on an individual basis. This is the weekly chart. Again, a nice breakout earlier this year, but at this point, as much as we like it on a relative basis, on an absolute basis, we don't want to be in it. We have a downward sloping 200-week moving average. We have a failed breakout, as you can see, and then the results. So we don't want to own India on its own. If we're going to be in India, we want to be shorting an equivalent amount of emerging markets, EEM, in order to take advantage of the relative strength, not necessarily the absolute strength. So this is one of those cases where you can be essentially equities neutral, and for every dollar that you're long India, PIN in this case, EPI is another India ETF, and they're both very liquid, and for every dollar you're long India, you're short a dollar of EEM. And that's how you can take advantage of the pair, because in this case, the absolute chart doesn't look that great. Here's a closer look. Here's a daily chart of India, a bearish divergence at the new highs and a failed breakout. Again, I've been seeing a lot of these in the S&P 500. We're seeing something similar. So obviously not something that we want to be in on an absolute basis. When it comes to India, we want to be in the pair. We want to be short EM against India for sure. It's one of the nicest charts that we see in the emerging market space. Here's South Korea. Getting back to it on an individual basis, on a weekly basis, on a relative basis, we didn't really like it that much. And now on an individual basis, it looks pretty terrible, doesn't it? You have a failed breakout above this downtrend line from 2007. However, do we want to be aggressively short with a flat 200-week moving average? Probably not, but we definitely don't want to be long. In all likelihood, it is going lower, but with a lack of trend, it makes it more difficult to trade because there is no trend. We'd rather be in something that's trending. So we know that on a relative basis, it's just there. On an individual basis, we definitely don't want to own it and might even be short. But it looks like I'd probably rather just stay away. Here it is shorter term, the South Korea on a daily chart. It looks terrible. It looks like it's going lower. Again, do we want to enter from an execution standpoint here? No, but you probably want to fade rallies. You get a bearish momentum divergence as well as a 200-day moving average that is now rolling over after a failed breakout. In all likelihood, this is probably going lower. Again, more evidence that perhaps we don't want to enter a short position today here, but a fade rallies, sell strength sort of mentality in South Korea is probably best. Speaking of terrible, here's Brazil. I mean, there are very few charts out there that look this horrible. So when it comes to momentum, we talked about it before briefly, and we talked about the divergences. So one of the most important things to recognize is that as bullish as these divergences might be, and as excited as we might get, when they fail, oh my God, look out below, because the market is speaking and the market is telling us that there are larger forces at work. It's a very similar sort of psychology behind seasonal trends. You know, if a particular market tends to do very well in the spring, let's just say, and the market does the complete opposite, look out, because there's larger forces at work. Good example of that is actually silver. September is historically one of the best months, if not the best month in silver, and silver crashed the entire month. So from a seasonal perspective, the fact that silver ignored that, those seasonal trends, makes me very, obviously I've been super bearish on silver for a while, but it's just more evidence of look out below in that market. So in this case, we have a bullish divergence. Oh, by the way, in silver, you have a bullish divergence on the weekly chart that's failing also. In this case, we have a bullish divergence in Brazil that's failing. There's nothing more bearish. This is a really nice bullish divergence too, but look at the declining 200-week moving average. So as great as momentum might be, the trend is still down. And that's the most important thing. So we know Brazil on a relative basis looks horrible. It's one of the worst in the emerging market space. And now on an absolute basis, it looks somehow even worse. So we want to continue to fade any strength in Brazil. This is a terrible market. It looks like it's going a lot lower. So we're really getting a good understanding of, the globe overall. Specifically, we've been focusing on emerging markets so far, but we're getting a better understanding of where the strength is, right? And what some of the more neutral markets, perhaps South Korea more neutral, China more neutral, India we love, Brazil we hate, right? So now we're already getting a better understanding of what we like and what we don't like. Here's a closer look at Brazil. Beautiful failed breakout, bearish divergence. Now momentum is in a bearish range. Again, all terrible things that continue to suggest fading this market. It's not somewhere we want to be long. And if you would have entered when that breakout failed on the bearish divergence, you had a wonderful risk reward, which is why I wanted to show you guys at the beginning, what happens from these failed breakouts and failed breakdowns. I look at a lot of charts and I see these again and again and again. The best trends start from failed moves. So instead of being scared of them, I like to try and anticipate them and look out for where we might see them. Now we're looking at Russia on its own. We know Russia on its own looks terrible, but on a relative basis, it looks terrible. And now on its own, it looks even worse. So notice how on any of these rallies, we have never gotten into overbought conditions in the relative strength index, and we have a declining 200-week moving average. And now we're gapping lower to start this week. I mean, there is nothing to like about Russia. Everything suggests continuing to sell strength. It looks like we're going lower. It's one of the worst emerging markets in the world. Here it is on the daily chart. Beautiful declining 200-day moving average. Nice failed breakout. Some might call that an island reversal. You can see the circle there shaded in gray. That is a nice chart. You want to continue to fade that strength. Everything about Russia suggests pretty much the same thing as we're seeing in emerging markets. Fade it on its own and on a relative basis as well. These are not places we want to be. It's not India. Here is Latin America as a group compared to emerging markets as a group. So, when we look at EM, we're talking about countries in Africa and countries out in South Pacific. We're talking about countries in Latin America as well, particularly Mexico and Brazil. But Latin America as a group, there are a lot of emerging markets. We could kind of take out the rest of the EM space, outside of Latin America. But somehow Latin America, as bad as emerging markets have been, somehow Latin America is even worse. Looks a lot like Brazil, right? So you have a nice downtrend line. You have former support that was broken. It was retested successfully earlier this year twice and heading lower. So not only do we hate EM, we hate Latin America even more. So if you have to be long emerging markets for whatever the reason, where do you want to be? The numerator, you want to be either India, and the denominators, you want to be fading Russia, fading Brazil. In this example here, Latin America as a group, faded. That's what you want to be short selling against some of the stronger countries. So far we like India, but even the United States, for example. If you want to be long the United States and short emerging markets, you can be short Latin America instead of emerging markets, because Latin America is somehow even worse than emerging markets as a group. I think this chart really shows that. So we hate emerging markets. We hate Latin America even more. So here's a good emerging market. Here's Mexico. So here's Mexico relative to the rest of the emerging markets, and look how nice this is. We have all these bad things to say about Russia and Brazil and all these. We can finally say something good. Look how nice Mexico has been compared to the rest of emerging markets. This is an uptrend. This is a bull market. So if you're going to be long anything, where do you want to be long? It's not Brazil, it's not Russia, but Mexico. Look on a relative basis. Look how nice Mexico looks compared to EM. We want to continue to buy weakness in Mexico while we're fading strength in emerging markets as a group. Now here's Mexico compared to Latin America specifically. So we know compared to emerging markets, it looks great. Now compared to Latin America, it looks like we're breaking out to new highs. You have a beautiful base that developed, about 3-4 year base, 2008, 09, 10. Look at that. You see that? And then a nice rally. So when we see these bases, like the one we talked about in Taiwan compared to EM, they tend to last for a long, long time. In this case, we've seen almost a double in the last several years. That's a big return in a nice steady trend. And these kind of trends develop from big bases, which is why I'm so excited about the potential in the Latin America, in the Taiwan versus emerging markets. Also, you know what? That's a really nice base is Canadian dollar, USD CAD. Really, really nice base. We broke out of that and retested it earlier this year. Now we're off to the races. I really, really love those big bases. I think this one's a good example. Mexico, you want to be buying Mexico, fading Latin America against that. Latin America as a group really, really looks poor. So within Latin America, we know Brazil is, arguably the worst place to be in Latin America. So as nice as this chart looks, this one's even nicer. So this is Mexico. Instead of short Latin America as a group, you're shorting Brazil. And we're already making new highs in this particular pair, breaking out to new highs. Very similar base throughout 08, 09, 2010, 2011. Beautiful, nice big breakout. 100% return over the last couple of years. That's a big, big move. And I think we're still heading higher. I mean, there's nothing not to like about this chart. So again, where you're essentially long Mexico and short Brazil. Every dollar you're long EWW, you're short a dollar of EWZ. And again, that's 100% return over the last couple of years. Still looks like it's heading higher. We really like that. So again, these common themes, we like Mexico. We hate Latin America, the rest of Latin America anyway, particularly Brazil. We like India on a relative basis. These are the things. So once you decide how nice this particular pair is, long Mexico, short Brazil, then you can figure out what's the best way to take advantage of that. Is it, keep it simple, stupid, and just buy EWW and short EWZ and call it a day? Or do you want to take it one step further and look at the individual components in the ETF? As I mentioned earlier, these ETFs have ADRs that trade in the United States, and you could buy the individual components that make up the exchange-traded fund. Here's a good example, Televisa, which is their media company in Mexico, and then shorting Vale, which is a Brazilian company, and look at that trend. That's been a triple over the last couple of years. I mean, you really can't ask for better performance. Continues to rip. And if you're looking at this chart of long Mexico, short Brazil, you shouldn't be surprised that one of the biggest components in Mexico is doing so well relative to one of the biggest components in Brazil. Again, a triple of your money in the last couple of years. And again, beautiful uptrend coming out of a strong base. Another perfect example of the types of trends that develop from huge bases, particularly in pairs around the world. These trends last for a long, long time, guys. Here's another example, América Móvil. This is the telecom company in Mexico, and then you short Vale against that. Nice trend, breaking of multiple downtrend lines. Look at that breakout earlier this year after the downtrend line. I mean, this is a huge trend. I mean, this is a monster, guys. Again, another double over the last couple of years. These are strong trends taking place as money comes out of Brazil and into Mexico. Another example, América Móvil, relative to Petrobras, Petróleo Brazil. Again, nice base, big uptrend. I mean, that looks great. So from an idea generation point of view, when we talk about a top-down approach and we look at the entire world, we start with the countries and we look at the pairs. We start with the groups of country, in this case, emerging markets or Latin America, and then we break it down into individual components and decide what's the best way to be in a particular theme. Is it just own the ETFs and shut up and call it a day, or be in some of the components? One last example, Televisa relative to Petrobras. Again, nice big base. Looks like a failed breakdown earlier this year below that uptrend line. Looks like we're heading a lot higher in this pair. I really, really like it. Again, the theme of being long Mexico, short Brazil, something that seems very attractive based on, what we're seeing. Continuing with the Mexico theme, another horrible component of Latin America and emerging markets as a group is Chile. One of the worst places to be, without a doubt. If I'm not mistaken, they have a lot of mining exposure and things like that. So the fact that, the metals and the miners and things like that and the coals and all that, that space has gotten crushed. It's going to affect countries like Peru and Chile that have that sort of exposure. Again, nice big base throughout 2009 to 2012, huge breakout, close to 100% return over the last couple of years. I'm breaking out to new highs. Looks to me like we want to just continue to buy weakness, perhaps back into that former resistance shaded in gray or the uptrend line. But, again, a bigger theme that we want to take advantage of when we have the opportunities from an execution standpoint. So continuing, not only can we, be in pairs of ETFs where we're long Mexico, short Brazil, or individual components where we're long America Mobil, short Petrobras, but you could be long a country ETF and then short a component in another one. I think this is a good example where you're long Mexico and then short LFL, which is the Chilean airlines. And look how nice this chart looks. You had a retest of that broken downtrend line that kind of trapped some people, trapped some shorts. Some people I'm sure got stopped out. And look at the monster squeeze from that failed breakdown. I absolutely love it. We're breaking out to new highs right now. It looks like we're heading a lot higher. Again, in that big theme of being long Mexico, short Latin America, where in Latin America, Brazil, Chile, short the bad ones, and then the individual components within them, for sure. Here's another example where we were long America Mobil and short the Chilean airlines. Nice big base over the last several years, nice symmetrical triangle coming into 2014, and look at the breakout, off to the races. Part of the same theme. So when we decide where the strength is, and we're looking at weekly charts, so we can get a much bigger structural perspective, and these trends, because they last so long, we're going to be given opportunities to get involved in different ways, whether it be in the ETFs or whether it be in the individual components of the ETFs. You got to look at the charts in order to figure out where you want to be, which is why we have our global macro package. I'll talk about it in a minute, where all of our members get once a week all of the annotated charts of all of the countries around the world. I really think that adds a lot of value for an investor. So here's developed markets, ex-North America versus emerging markets. So again, we know we hate emerging markets as a group. Now, how are emerging markets relative to the developed countries? In this case, we're looking at a nice base from 2010, 2011, 2012, a nice breakout at the end of 2012, and now we're essentially retesting that. But it looks to me like this retest of the breakout, I think it's just that. I think it's a retest, and this is part of a bigger emerging trend of money continuing to come out of emerging markets and into developed nations. We saw the first chart earlier, which is against the United States. That's a great one. It's even better than the rest of developed markets as well. But again, part of the same theme. Here's Japan relative to the United States. So now that we figured out that we don't like Latin America, we don't like emerging markets, but we like the developed countries over that, now let's start looking for some strength. Here's Japan, which is one of the biggest developed nations in the world, obviously. And it's not really telling us much. What do we want to do with this? Probably nothing. We broke out of an uptrend, of a downtrend line. We broke out, consolidated. Instead of breaking out, like was what you wanted to see, we got nothing. So Japan on a relative basis, not giving us any information. So we probably just want to stay away from it on a relative basis. Now here's Europe compared to emerging markets. the Euro Stoxx 50, which is essentially the Dow of Europe, breaking a downtrend line and kind of figuring out what it wants to do. I'm not super thrilled with the recent behavior. I think some time and some basing is likely necessary. So if we want to be shorting emerging markets, do we want to be long Europe as the numerator? Probably not. How about Australia, another big developed nation? Here's Australia relative to emerging markets. Nice big base. I really like this retest of support. If you're going to be fading emerging markets, Australia might not be a bad place to be on a relative basis compared to EM. Not the best, right? The United States looks so much better compared to EM. Even developed nations outside of North America look better than Australia. So I think you're forcing it here, but I do like it compared to a lot of the other charts that we just saw. Here's Australia on its own. It looks like a big consolidation. Not really much to say. A flat 200-week moving average. We're still in the middle of this giant consolidation that we've had over the last 4 or 5 years. Really not much to say. Can you buy it here and stay long above the uptrend line? Sure. How much upside do you have? Is it worth the risk? There's a lack of trend. To me, when there's a lack of trend, I think to be in it, I think you're just forcing it. I'd rather just stay away. Here's Europe compared to the S&P 500, which is one of the most beautiful trends of any of the charts that I've shown you guys. I mean, look how nice this is. You have a beautiful stair step. You got, in 2008, you got your rally, sold off in 09, broke that support. Then in 2010, retested that broken support, broke down. Then in 2011, it broke that support and it continued to sell off. And now we have a nice symmetrical triangle the last couple of years, and we're breaking down to new lows. So if we're going to be in developed nations, Europe compared to emerging markets doesn't look good. And now Europe compared to the S&P 500 looks terrible. So you want to be fading Europe compared to the S&P 500. So shorting Europe as a hedge against United States longs has been a great trend that continues to work, and I see no evidence of this changing at all. Quite the opposite. We're seeing new lows. So I think you fade Europe on a relative basis. Absolutely, nothing to like here. Here's Europe on its own. Again, nothing to like. Nice failed breakout earlier in the year. We still haven't gotten above the 2009 highs. If you do a retracement of where this shaded gray area is, that's been resistance over the last 5 years, that's actually exactly a 50% retracement from the entire 2007 to 2009 decline. This is 50% like to the penny. So when you talk about retracements, when you talk about Fibonacci, the people that say it's nonsense and it doesn't work, I mean, show them a chart of Europe. I mean, 50% to the penny. And we continue to struggle with that level even this year when all the permables, got all excited about Europe. We were not breaking out. It was a failed breakout. So you want to stay away from this. And then here's the short-term chart breaking down, making new lows. So do we want to be in Europe? No. I think you want to keep fading it both on an absolute and relative basis. There's nothing to like in Europe. Just a couple more guys. And then we'll get to the questions. Here's Europe compared to Australia. Again, you can look at different ratios between developed nations as well. Europe compared to Australia looks like a hot mess to me. We want to stay away from this. And then some individual components in Europe. Here's Germany on its own breaking down, so we can see why Europe as a group looks terrible, because Germany, one of the biggest components, looks even worse. Look at that failed breakout earlier last year, and now we're breaking down below the uptrend line. It looks terrible. There's nothing to like here. Here's Deutsche Bank compared to Germany. So Deutsche, obviously, as we know, has gotten crushed. But compared to Germany, it does look interesting, because if we can get back above that broken support from the end of 2008, which was also support in 2012, if we get back above that, not only is this a failed breakdown in the pair, but we're also above the downtrend line that goes back many, many years. So we can see a huge squeeze. Now, I'm getting way ahead of myself. I'm not saying buy Deutsche Bank. I'm not saying that at all. But we do want to be aware of what's transpiring here. Because if we do get above that one, let's call it 1.6, something like that, oh, man, look out, because we could see a monster squeeze. So something to look out for. Here's Germany compared to emerging markets. Actually doesn't look too bad. retesting this former support that was broken. Nice big base. Do I love it? I guess you could stay long above the recent lows this year, but I don't love it. I think there's better charts relative to EM that we've looked at. And here's Europe relative to Germany. So this is Europe as a group compared to Germany, where you're essentially long Europe, short Germany. I got to tell you, it looks nice. It really does look nice. So I would argue that we'd be looking for Germany to continue to underperform Europe as a group. And we know we already don't like Europe. So we already don't like Europe, and we like Germany even less. What does that say about Germany? So, another one of these countries that we want to be fading because of the amount of weakness that we're seeing. So, we could do this all day, guys. I literally do it all day. But we want to keep it short. We want to get to the questions. I know a bunch of you guys have some questions. What I wanted to do was kind of just go over this real quick. We're offering, this is very short term, we're offering the 2 sets of newsletters, not just our global macro newsletter. I'll show you guys the ticker symbols in a minute, but you're also getting our S&P sectors. So the S&P sectors has all of the financials, energy, et cetera, et cetera. I'll go over this now, and you'll get both for $100, really for the entire year, and $1,000 for the entire year. So I think it's one of the better offers that we have. Here are the ticker symbols for the global markets. You're getting everything from EM, China that we discussed, to a lot of the countries that we didn't even mention, Austria and Turkey and the Netherlands, a lot of the European nations, even some of the African nations, and a lot of the stuff out in Asia Pacific. As you can see, you're getting a lot of charts, over 80 charts once a week on multiple time frames with momentum, commentary on momentum, commentary on relative strength, commentary on trend and pattern recognition. And then here are the S&P sectors as well. So you can see it's not just the major sectors, but it's the subsectors as well. The biotechs, the real estate, semiconductors, social media and internet, coal, which has been, terrible, terrible sector, aerospace, which is really interesting on a relative basis. So I think it's a great package to really get a better understanding of not just what's happening around the world, but what's happening here in the States as well. Again, $1,000, you get both packages, and you can message me directly. Go to www.vip.marketfi.com/Eagle Bay, and you can sign up for everything there. You can also find all the products on eaglebaysolutions.com. And listen, I'm easy to find. Find me on Twitter, All-Star Charts, or email me, or email us at the company at info@eaglebaycapital.com. And please, feel free to reach out. We'll get back to you within 24 hours, as close to that as we can. So I really appreciate that. And, we'll get on to the questions here before we get any further. John asked, JC, can you explain what comes in the global macro package? Sure. As we mentioned before, let's just go back here. Again, you're getting all of these countries once per week. Once per week, you're getting all of these countries on multiple time frames. Everything in Asia Pacific, all over Europe, Canada, Latin America, which is really interesting. I want to focus on that in this particular webinar. I know we didn't have time to go over the entire world, but there's so many interesting things happening in Latin America, particularly bearish. So I really wanted to focus on that area of the world. But that sort of analysis can also be done in the Asia Pacific countries, in Europe, and then compare the two depending on where the strength is. So JC, can you go back to the correlation matrix between countries? You have the correlation differences in bull and bear markets. That's actually a great question. So in bear markets, correlations tend to pick up. I'll go back to that. Let's see. How to do this? We'll go back. Here we go. So here we are, the correlation matrix. Sure, in bear markets, when the world is crashing, correlations are going to pick up, because what happens is money managers, they'll just sell and ask questions later. So the counter trend rallies that you get in bear markets are generally very vicious. The ones that got hit the hardest tend to bounce the most. So they'll do that together. Go back to like 2008, 2009, for example. Correlations across asset classes, across different countries, really picked up. It was really interesting. So I would argue that yes, correlations do pick up during bear markets, totally. So I think that's where it's even more important to be long one and short another in the pairs trade. So another question that we have here, what do you see in Brazil going forward? I got to tell you, there's nothing to like. On a relative basis, it looks terrible. Emerging markets, as terrible as EM looks, Brazil somehow looks even worse. So it's not something we want to be buying. We want to continue to fade that. Let's see. Here we go. What is the risk with pair trades? I would argue that it's the same amount of risk that you're going to have in really any sort of a trade. The way we look at pairs is the same exact way that that we look at individual names. So let's say we're buying Microsoft for whatever reason, and we see support in Microsoft 50 cents below where we own it, but we have 5 points of upside in our opinion from previous resistance. Let's just say, for argument's sake, if we have 5 points to the upside, 50 cents to the downside where we're going to put our stop, that's a 10-to-1 risk reward. I'll take that. And that's in an individual name. Now, in a pair, it's going to be the same idea. I mean, let's see. We'll let's use this for example, where you're essentially buying SPY and shorting EEM against it, right? So flip this chart upside down. The risk in this chart, in this pair trade, is that the pair gets back above the gray shaded area. That's the risk. So what's the reward? It's tough to quantify here at this point. I would argue that it's probably heading towards about 1.6 based on resistance from early in 2004. So 1.6 from here, you're looking at what, 5 points? And what's the risk to the upside? About 3 or 4. So from a risk reward standpoint, the ratio here just does not make sense to enter. But if it did, let's say it was a 10-to-1 risk reward, we would take it. So my answer to you is that I would treat the individual pairs the way you treat individual names for risk management purposes. I mean, that would be it. Treat them the same way. JC, what do you think of metals? Sentiment seems very one-sided. I take it you're probably talking about precious metals. I've been very bearish precious metals for a long time. You want to talk about weak markets? When it comes to sentiment has been so bearish in metals. Let's just go with silver for now, but gold, same thing. When we started crashing early last summer and sentiment got to really bearish levels, when we would rally and then retest that support from last summer, I believe we tested it in December, sentiment got very bearish as well. And then we got a nice bounce. And then we rolled over again, I think in May, we met that support again for the third or fourth time. And again, sentiment was very, very bearish, extreme. So my argument on this last test of this support, which was arguably the fourth or fifth test, sentiment was nowhere near as bad as it's been over the last year. So my argument was that the catalyst to take this lower was the lack of bearish sentiment. Now, with that said, we've crashed big time in silver. So I would argue that now sentiment is getting back to those bearish extremes. But price is the only thing that pays, right? And we broke some monster support levels. So as long as silver stays below that, call it 18.5, 19 area, I would be selling any strength into that area. I'm not even saying that we're going up that high. I'm saying that former support, which we discussed here, right? This is silver. Here we go. I'm going to show you guys silver. That's silver right there. So the first test of that line was last summer. Then the second test was in December. The third test is in May. Then we broke down, and we're somewhere down there below. This is a good example of what I think silver can potentially do if we do even get a rally up there. And then I think it'll roll over. So if anybody's curious on silver or metals or sentiment, we do have a commodities and currencies package. I see a couple of you guys asking that as well. The commodities and currencies package is 17 commodities and 9 currency crosses, including the dollar index. And that's sent weekly, multiple time frames, daily and weekly, with momentum analysis, pattern recognition, Fibonacci projections as well. Those are particularly helpful in the currency markets because they're so volatile and the trends last for so long, uptrends and downtrends, that looking for support and resistance levels using Fibonacci really helps. In fact, getting back to silver, Where was the low this week in silver was at the 161.8% Fibonacci extension from the most recent correction in the summer. So are we going to break that level? I would argue that we probably are, but it's not a coincidence that the last 3 days that low has held. So I think it's important, and I think that helps. So that particular package is $79 a month and $790 for the entire year. So the next question that we have is, JC, what package is what is the best offer? I would say that the best offer is where you get all of them, because when you do the math, that's really the biggest discount. So we have 5 packages. We have the S&P sectors. We have the global macro that we just mentioned. We have the currencies and commodities that we just talked about. We also have the Dow 30 components, all Dow 30 stocks on multiple time frames. And you also get all of the major U.S. averages and interest rate charts, which, anything from S&P 500 to the Dow, small caps, mid caps, micro caps, treasury bonds, interest rates, volatility index, the New York Stock Exchange composite, for example. You're getting all of those, and that's $2,999 for the entire year. So when you talk about discount-wise, where's the most value? I would say that's without a doubt the best value. And if you guys go to eaglebaysolutions.com, or you can email me at info@eaglebaycapital.com, and we'll go ahead and send you a link to that as well. In fact, if you go to allstarcharts.com right now, on the main page, at the bottom of the blog post about S&P and Dow, you'll see a link to that particular package. JC, do you place same amount of capital across all positions? How do you value the risk reward? That's a great question. For me, it's not so much, okay, I'm gonna put 5% of my capital in every trade that I do. It's not about that. It's really more calculating the risk. In some cases, the risk is going to be more than others. So in a case where I might be risking 1% of the entire portfolio in a particular trade, I would only do that if the upside was anywhere between 8 to 10% of the entire portfolio. Again, looking for risk reward opportunities that are very much skewed in my favor. Selfishly, we can be, patience is one of the most important things, really that I've learned over the years in this business, is being patient. We don't have to trade everything. It's okay to say no. And be like, hey, I'm moving on. I don't like this. A lot of cases, at some of the charts that we looked at today, I'm like, hey, it's not really telling us much. A good example of that was in the, a good example of that was in the Australia versus Europe. There wasn't anything there. There wasn't anything to really excite us about. Here, for example, here's Australia. I'm saying no, it's not there. Like, sure, we can buy it with a tight stop, but what's the upside? To me, it's a lack of trend. Stay away. This one I like. Fading Europe and buying U.S. stocks. I mean, this is a beautiful trend. So I could say yes to that. Fading strength in Europe, I can get with that. Again, the breakdowns, I can get with that. This chart does nothing for me. This, Europe versus Australia. It's not for me. So we'll do a couple of more questions. Let's see. Trying to get to as many of these questions as I can. Let's see. JC, I presume these are weekly correlations, and what period? The correlations that we were talking about were actually over the last 30 trading days. Just as an example, of the U.S. stocks over the last 30 days being very correlated to one another, while the rest of the world has much less correlations. So that's what those are. But in our packages, you're going to get all of the correlation coefficient of all of these countries relative to the S&P 500. So you're going to know what the correlations are in Mexico, for example, relative to the United States over the previous month, over the previous quarter, and over the previous year for every single country. Same thing in the U.S. sectors. You're going to get the same correlation analysis over the previous month, quarter, and year. And I think that adds a lot of value, particularly from a risk-reward standpoint. We're constantly stressing our positions against the U.S. dollar, against treasuries, against the S&P, against gold, against oil. Our goal is to get zeros across the board. We know that's impossible, but from a risk management standpoint, we want to get as close to those zeros as possible, knowing that ahead of time. With global growth estimated to decline and trade outlook being revised down by the WTO, what is your outlook for further S&P outperformance given? I don't know anything about global growth. I don't even know what the WTO is. World Trade Organization, I'm going to go with. I don't look at economics. I try to ignore all that stuff. It's very lagging. When we look at the markets are a forward-looking mechanism. And I'm just going to end it with this. We look at forward-looking markets, which is what stocks are, is what commodities are. News follows price. Why do you think the U.S. dollar is all over the news lately? Because it's been ripping since May. But guess what? In May, nobody was talking about it because it was boring. I'm telling my buddies, hey guys, U.S. dollars. JC, shut up with your dollars. Look at Tesla. That's just reality. And now news has followed price. So I try to ignore all news. Remember, these news outlets have their own biases. They're not there to help us make money. They're there to sell commercials and sell advertisements. So there's a conflict of interest there. In the case of the sell-side community, sell-side analysts, they have their own conflicts of interest as well, career risk. For us market participants, we don't have to worry about any of that stuff. We just have to worry about managing risk and making money. That's the only reason why we're in the market. So, I think that's a great question, and I wish I had a better answer for you, but I just ignore all that stuff and really focus on price. So when it comes to S&P's outperformance, I'm looking at really nice trends, particularly against emerging markets, particularly against Europe. So I would argue that as long as price continues to trend in that direction, to stick with it, because trends, by definition, generally continue to trend rather than reverse. So that would be my answer. And if you guys have any further questions, please feel free to email me info@eaglebaycapital.com. I think this is a great package, guys. I really want you to take advantage of it. You're going to get a lot of countries. You're going to get a lot of analysis, a lot of trading ideas. This is one of my favorite personal packages because I like looking all over the world. My geography has gotten so much better over the years because I'm looking at all these countries. I can pick them out. So just once again, www.vip.marketfi.com/EagleBay. And listen, we got great turnout today. I really appreciate you guys, listening. I hope that you found value in this. I know earlier in my career when I was trying to learn technical analysis, I got a lot of value from people that came before me and learning from them. So, I really appreciate, you guys sticking with me. And like I said, if you have any more questions, sorry I couldn't get to all of them. Any more questions you have, just feel free to email me, info@eaglebaycapital.com. So thanks again, guys.